What is involuntary conversion? I was forced to change my house because there was a tsunami, because there was an earthquake, because the government took over my property. Now, when that is happening, I'm not going to treat it as if it's a sale of a house. It's not a taxable event. It is regarded as a non-taxable event. Now imagine if I have an ancestral house and the value in my books was, let's say, $200,000. The market value of it was, let's say, $1,000,000. But the moment there's an involuntary conversion and I make it a taxable event, immediately the government would have to take a portion of this $800,000 gain. So the poor chap lost his house, $50,000 to the government, and then another money he has to pay to buy a new house to stay in. We cannot afford that. So what we say is very simple. Whatever money you are getting, so if there was an insurance proceed, if there was a government reward, whatever money you are getting, if you're able to pull the entire money and put it for the buying of a new house, I am not going to think about what was the old house cost, what is the new house cost, nothing. If you could roll over the entire receipt for buying another residence for yourself, because your principal property was destroyed for reasons or involuntarily converted for reasons beyond your control, then the only thing that I have to see is that there should not be any part of the money that you received which you did not reinvest. Only that part I would be taxing in your. See, no gain is recognized on the rationale that the taxpayer's reinvestment of involuntarily received proceeds restores him to the possession he held prior to the conversion. I was staying in a house. Now, unfortunately, that house was taken over by the government. Now I'm buying a new house. But the idea is I'm just staying in a house. That's it. However, if there's any part that you did not reinvest, that part I would tax in your hands. For the new property that you have now received, the value at which you will write it in your balance sheet, that means the basis of that property acquired, is equal to the cost of such property decreased by the amount of any gain that you could defer. Now let's just take some questions so that we'll understand this. Remember, we are not talking about losses here. We are only talking about gains. If there is a loss, we don't deduct that loss also. Okay? Look at this question. Sandra must recognize a gain of what figure? Sandra's business office was condemned to make way for an expanded highway on May 1, year 1. Sandra's adjusted basis on the building was $20,000, where we had the original cost less depreciation, and her proceeds from condemnation was $220,000. Can you see this? She bought a house really long time back. In her books, that house was for $20,000, but when the house was destroyed, when the house was taken over, she replaced her office on November 10, year 1 at a cost of $185,000. Did she reinvest the full amount? The answer is no. Had she reinvested $220,000, I would have given her the entire amount free of tax. But the amount not reinvested is the gain that has to be recognized. So how much is it? It is $8,000. So I think it is $35,000. So the gain not recognized in the books is $35,000. Is this clear? Very easy, right? It's a concept. Always understand that you will get a lot of questions from these areas. What is important is to understand. See, if you understand the base was what is taxable, what is non-taxable. So every event can be categorized as taxable versus non-taxable. Now it is up to you to understand what is the logic behind all of that. If you're able to connect the concept with the logic, then even if you get a question where you can't put your finger and say which topic it is from, that logic will guide you to answer the question. Okay. Now this is a very good question. Okay. A very, very good. A little advanced, but a very good question. See this. What is the basis of the replacement property? Jeannie owned a duplex and lived in one half. The other half was a rental property. So I have two flats. One is for my own and the other is the rented one. The cost of the property was $80,000, out of which $70,000 was to building, $10,000 was to land. In the current year, the property was condemned by the city. Up to that time, she had allowed a depreciation of $23,000. Now see, what is the meaning of this word? What is the meaning of this phrase? That means, see, the property was held for personal and for rental purposes. That means if I look at the cost of the property, $40,000 was personal. So the property value was $80,000. $40,000 was rental. Now I know this depreciation I will never give for personal purposes. That means this entire 23,000 should have been used only for the rental purposes. So how much was this? I think 17,000. Is this clear? Everybody, 1 second. And this was still 40,000. The city paid $70,000 and she bought another for $85,000. That means she paid more. So when she paid more, then it is different. Jeannie lived in one half and the other half is rental. So one duplex was taken away and the other duplex was given. She got 70, she reinvested entire 70. Now the question is, what is the basis of the replacement property? How much are you going to take as a basis of the property? Now see, if you look at it, how much was paid to her by the city? So if you look at it, the selling process, if you regard it as a payment, how much was the payment made? She received $35,000 for each half she received that happened. That means in the first house there was a loss, and in the first house there was a loss, and the second house there was a profit. How much was the profit? Just calculate. 18,000. Can you see this? What has happened? When the property was taken away, for the first half, there was a loss of 5,000. For the next half, there was a profit of $5,000. Is this clear, guys? So now tell me, what is the basis of a property? What would be the basis of the new property? That just give me an answer. A, B, C, or D. Think. See, I know it cannot be 85. That I'm very clear. Because the entire amount cannot be the basis, right? And this loss is a non-deductible loss. Do you all agree? This loss is a non-deductible loss. Okay, now think about it like this. So what is the basis of the replacement property? So what I'll do, I'll take $85,000 divided by 2. So this becomes 42,500. Is this clear? So see what is happening. Again, if I look at it, since she has reinvested that entire amount, she has reinvested the entire amount in buying another property. So obviously there will be no gain that would be allowed as taxation. But what will be the basis of the new property? The basis of the new property is the amount that you have invested in the new property minus the gain that was deferred to you. So if you look at it, my personal and my rental property, the new basis would have been 42,500 and 42,500 for both of them. But in this case, there was no gain that was allowed as a deduction earlier. So the personal part of the property would still remain at 42,500 in the books of the taxpayer. But in this case, there was a gain of 18,000 which was not recognized in the books. So for minus 18,000 gives you 24,500. So I add this up and the basis of my new property will become $67,000. So the answer becomes B. Are you able to see? This is a complicated question, okay? Somehow I don't see them asking you questions which are this complicated, but these questions are very important in explaining the concept to you guys, okay? So understand what is happening here. One half of the property is personal, one half of the property is rental, and these are segregated parts. Now, the losses we are not talking about. Losses are not allowed. But if there's a gain, I will disallow the gain to you, provided you should have reinvested the entire amount in buying the new house. Now, obviously, in this case, can you see that she paid 15,000 extra from her pocket? So ideally, if nothing would have changed, the new property basis would have been 70 in my books. But I invested furthermore. So the new property basis should have been 85 now. But out of this 85, so if you think about it at a very, very superficial level, out of this 85, see, this is a very simple way of doing this. The one that I explained to you was a very, very complicated concept. But I had to split it to help you understand the calculation. If you are able to understand this logic, see, what I'm trying to tell you is, I had a house, it got destroyed. I got a new house into the picture. Ideally, whatever amount I would have spent for the old, I should have replaced it with a new property. And the no gains would be taxable if I would have reinvested the entire amount. But the problem is, the new house that was got was at 85, and I had already there was a gain of 18. Now, it's important to calculate the gain of 18. That's the reason we have to split it. Why? Because the personal portion, there would be no deduction. But for the rental portion, there would be a deduction. So personal losses disallowed. Rental, there was an 18,000 gain. That would be excluded from tax because you had reinvested the entire property to buy a new property. So if you look at it, out of this 85, if you remove 18, that becomes the basis of the new property in your hands. But if you want to break it down further, and you can still take it personal and rental. Personal, you got the house for 42,500 and no amount of gain was taxable, was tax exempt. So the personal portion still remains 40. But the rental portion, now there was a gain of 18 which you had pushed aside and deferred. So that cannot be included in the basis of the property. So now the basis of the new property becomes 42,500 and 24,500, which would add up to 67, which in very simple language could also have been 85K minus 18K, which is 67K. But if you look at the provision now, this becomes crystal clear. See, no gain is recognized if you would have reinvested the entire amount. How much I did not reinvest, that becomes tax. The basis of property acquired is the cost of such property decreased. So cost of such property was 85,000, decreased by the amount by which any gain not recognized upon such conversion. So there was a gain of 18,000 for the rental property that I did not recognize. So this entire amount becomes the basis of the new property. If there's a loss, they're not deductible. So 5,000 loss on the personal portion of the property is not deductible. I don't see them putting you a question like this directly. They generally don't give you these complicated questions. The reason we are doing it is through one question, we explain all the provision. We explain you business versus rental. We explain you loss. We explain you the gain. And we explain you how are you going to calculate the basis of the property. All the four concepts in one question. Concept should be clear because when they ask you a question, trust me, they're not going to give you these kind of complicated questions. They might give you one part of the question. They might give you a question on the basis, on the gain exclusion, on the gain inclusion, personal losses disallowed, or gains not recognized. So any of these questions would come, but you should be able to handle it confidently. Okay, so that is the second concept getting done today, which was installment sales, which was involuntary conversion. So we've done homeowners exclusion, we've done involuntary conversion.